Welcome, welcome, welcome everyone to another exciting K.I.G property management webinar. We're so excited to jump into this topic, identifying overlooked deductions and maximizing 2025 write-offs. We're giving you today practical tips to reduce your 2025 tax burden. Thank you so much for joining. We have an exciting group of panelists today. We've got Jared Carpel, our CEO of K.I.G Property Management. We are joined as well by our COO, Jit Agarwal, who's going to also help us guide through this super exciting topic. And then you've got me, yours truly, your host in all this. So thank you so much for joining. We've got some questions. We'll have time for questions towards the end. But let's get started because this is a super important one and very timely. So why does this topic matter? And Jared, I want to jump to you as the CEO of a property management company. Why do deductions, these year-end expenses, why does any of this really matter to people?
Thank you, Derek. Thanks for having us and leading this today. So at the end of the day, I think what folks fail to realize is that managing a property and running a property is no different, and it's actually is like running a business. And so what we really want to be careful of and be mindful of is ensuring that you take the appropriate deductions based upon various expenses that maybe you have made on the property, which will ultimately reduce your taxable income. So, and keeping that in mind, that the last time to do that is by the end of the year, December 31st of this year, or any year for that matter. And so you want to be proactive now, if not sooner than now, but certainly now, to ensure that you have all the proper documentation. And we'll talk about kind of what to do, but this is why it matters, because you're going to be reducing your taxable income as a result of properly documenting these deductions.
Got it. So along with planning holiday parties and New Year's parties, folks should be thinking about this as well. Maybe even more important than all of that. But in any event, let's keep going. Let's talk, Jit, you've owned and managed properties for years and so on. I'd love to get your thoughts. And of course, Jared, yours too. What are some of these common overlooked deductions that people don't often think about?
Thanks, Derek. Thanks for having me both, Jared and Derek. Decades of that. So travel and mileage. A lot of times owners don't think about the time and energy and the cost it takes to travel to their properties or those Home Depot supply runs. Every one of those times are tax deductible. If you keep track of it, you get a very nice per mileage deduction from the IRS. I think it's north of 60 cents. And so it really is very, very adds up very quickly. And you'd be surprised. Think about also your home office deductions. Even partially used is qualifies. And let me give you a little bit of a tip here on home office deductions. There are actually two approaches. One is called the simplified approach. The simplified approach gives you $5 a square foot for 300 square feet for $1,500 that you can just take. You don't have to do anything, just put it in and you're done. That's the quick and easy way of getting a home office deduction. However, if you're willing to go through the effort, there's an actual method as well. It's the actual expense method. And the actual expense method allows you to take mortgage interest, property taxes, utilities, home insurance, repairs, and depreciation, a percentage of all of those costs and expenses for your home office deduction. So that same $1,500 that would be for 300 square feet at $5 a square foot could be as much as $10,000 if you take all of these things into consideration. So that home office deduction may not seem like a lot, but it can add up pretty quickly.
I did not know all that. Thank you for that. That was incredible. All right, professional fees. I know that's one of them. Jared, maybe I'll throw this over to you as a CEO of a successful property management company. Professional fees to a management company, to an accountant, a contractor, any legal expense, those are also deductible?
Yeah, as long as you're seeking these professionals in the confines or in the auspice of furthering the property's business, the business of managing and operating the property. Something to also note too, let's say oftentimes we take our accountant out for lunch. We take our lawyer out for lunch. If they're not paying and we're paying, make sure you print up that receipt or have a calendar event that you're going to lunch with your lawyer and that receipt, hold on to it, put in the notes, write in the note the receipt, went to lunch with lawyer so and so and discuss such and such. And as long as there is you've had some discussions about the business, all of that can be deducted. Absolutely.
And that's an interesting point you make. It has to be about the property. So let's say an owner has some sort of legal issue, a DUI, a divorce, something like that. Yeah, God forbid, obviously. But those are not considered legal expenses that can be deducted from managing a property, obviously. Like it has to be in the vein of managing that property. Is that?
Yeah, correct. Just make sure that you're throwing in some discussions about getting advice for the property, and as long as it's defensible and reasonable, you should be okay.
Awesome. Very good. Let's talk maintenance and repairs. Maybe Jed or Jared, both of you, I really would be curious about this. This one I think is probably going to be very interesting to people.
Sure. Jared, do you want me to start and then chime in?
Go
Perfect. So if you think about maintenance and repairs, the deductions really come in when you do capital improvements, not really repairs, but more capital improvements. So what might capital improvements be? A new roof, HVAC, you have to do some plumbing retrofitting or electrical upgrades, a kitchen remodel, a bathroom remodel because the old tenant left and left it a pigsty, maybe some flooring that needs to be replaced, the old carpets need to be ripped out and new ones, maybe some landscaping. And these kinds of upgrades or capital improvements are really where you get the most bang for the buck from your maintenance and repair dollars and the ability to create deductions around that. So things that are improvements, restorations in case like there's water damage, or adaptations where you're taking something and reconfiguring the property for a different type of use or an expanded use case. These are the kinds of maintenance and repairs that really fall into the capital improvements that you can then take into deductions.
Got it.
Let me add to that if I can, just piggyback. Some of the big capital improvements that we've been seeing here, at least in California, for the past several years. The first one was the earthquake retrofit. We had to, in state law, retrofit various properties, soft story buildings. All those are capital improvements that can be deducted. You also have the most recent is the balcony inspections, inspections, and any subsequent work that needed to be done to ensure that the balconies are in sound structural capacity condition. So those are some two big ticket item capital improvements that you definitely want to hold on to those receipts.
And I was going to actually ask you about that. As a property management company, is that one of your responsibilities to hold on to those receipts and provide them to the owner to help them have these deeper conversations with their accountants?
Yeah, exactly. So what we do in our reporting, because we believe in having accurate books and records, ensuring that we have transparency in all of our reporting. So we will not only track those for you and get those paid to the vendor, but we'll also have a report that our clients can actually provide to their accountant, to the CPA at the end of the year, so that making these deductions a lot easier for our clients and their professional bookkeepers or accountants, what have you.
Got it. Thank you. All right, let's talk then depreciation. This one I think may come as a shock to some people.
Well, and I think it's interesting to know, we just talked about those capital improvements. Those capital improvements actually become independent depreciations. They're depreciated independently of the property itself. So if you spend $100,000 on that balcony retrofit or $150,000 on that earthquake retrofit, it actually creates a separate depreciable event for you that you do that 27.5 years for that depreciation expense in addition to your normal property depreciation. So consider it as an additional depreciation. On top of that, there's what I love to call bonus depreciation. And what you might ask is bonus depreciation. Well, it's the ability to accelerate the depreciation 5 years, 7 years, 15 years on a select type of activity, a select type of expenses, like appliances is 5 years, so is carpet. If you had to do some landscaping or fences or exterior work, it's 15 years, cabinetry, 7 years. So there are accelerated or bonus depreciation options for capital improvements that are associated with the type of actual capital improvement that you do, which could really accelerate the value and the savings to you in terms of your taxes between both the independent depreciation you get for capital improvement and then the bonus or accelerated depreciation you get for things that fall into those IRS categories.
Got it. Got it. Interesting. Final deduction, a subscription and licenses. Jared, maybe you
Yeah.
can jump in and chime in on some of that.
Yeah, that is something that's actually quite often overlooked by owners in terms of possible deductions. So obviously, if you have you have to have a city license in order to a business license. Plus, you have to do register with if you're particularly if you're in LA City rent control, you have to register every February. All those fees are complete deductions. Something else too. A lot of our owners subscribe to AOA, Apartment Owner Association, or AGLA, or other trade magazines and publications, and there's fees for that. Those are great. I'm not trying to plug those various.
I was going to say Dan Eukelson owes us a dinner for that plug.
Yeah, was not intending to do that, but nonetheless, it's a reality, right? And so I want to make sure that our clients are capturing as much of those deductions as possible, since it is related to a business expense, and the business is operating the property.
Got it. I wanted to then jump in talking about property specific write-off opportunities. I know that, we've talked a little bit about like the capital improvements, but what can you say about preventative and proactive maintenance? Because I think now as we're approaching these deadlines, like people obviously need to start thinking a little bit about some of this.
Yeah, I think it's a perfect opportunity to come in and proactively think about all of the improvements you can make in terms of thinking about both for this year that you've maybe perhaps waited or delayed because of various reasons, but also for next year, thinking ahead of what's going to happen in the rainy season, what's at least here in the LA area, what's going to happen then in the winter, or sorry, in the summer when you have those the heat comes in and the sun comes out, and a lot of those things that were wet now are drying up, and then again. So if you're able to take some of those kinds of improvements and repairs and upgrades and do them now, while you have potentially the available resources and people, as well as the dollars, as well as the opportunity to take advantage of it, you
Yeah.
can dramatically shift your cost structure and reduce your overall taxable income for 2025 by acting quickly. And an example of those would be some of the energy efficient and federal credits for some of the high efficiency upgrade, HVAC, windows, insulation. And some of those, if I'm not wrong, are expiring this year. And so you want to take advantage of that before they expire. I don't know all of them and all of their expiration dates, but some of them definitely are. So you want to get in while the getting is good to take advantage of those kinds of things and make sure you take advantage of any kind of tax credits or benefits that they have for that. Like solar, for example, is expiring this year.
Wow. Interesting. Okay. Good to know. I know we talked a little bit on maybe the previous slide about professional services, fees paid to property managers, bookkeepers, architects, designers, and contractors. So I think we covered that. Unless anything new you want to say, but Jared, I was really interested in this. Again, someone you've been managing, you do this all day long, every day. Tenant turnover costs. Can you talk to us about those kinds of write-offs?
Yeah, so it is not cheap to turn over a tenant these days, especially if you have a tenant that has destroyed the unit, which does happen. Even despite being a really effective property manager, you can't really control the behavior of your tenants sometimes, despite best efforts. So those can be very costly. And what is part of tenant turnover costs are not just cleaning the unit and getting all the stuff they left behind, the abandoned items out. It's also, obviously cleaning and doing the repairs and the patching and the painting and all that sort of stuff, as well as then now we have to advertising. So all the advertising costs are a great write-off. So if you're advertising for Zillow or Radpad or apartments.com, again, not trying to do any plugs, but to illustrate some of the most common advertising techniques that we utilize to drive in prospective tenants, those are all write-offs. Screening, background checks. Oftentimes, owners overlook that there is a fee, a cost associated with doing a background check, whether it be through us or through a third-party company. We try to pass those costs on to our tenants, but mom and pop owners will absorb that cost and without actually tracking that as a potential write-off. So definitely keep in mind that all of that could be written off. So keep those receipts and put in a spreadsheet. If you're kind of an Excel person, you don't have a software like a professional management company may have, and make sure you track those and hold those over for your CPA at the end of the year.
Well, speaking at the end of the year, we are here, and we got a few more weeks left. I really want to talk about how timing is everything. I know it sounds so glib to say that timing is everything in life, but boy, I think it really is when it comes to deductions, especially when it comes to property. Let's talk about some of these taxes that are coming up and how it affects insurance and so on, and some of these other really time-sensitive situations that folks really need to start thinking about right now.
Yeah, so obviously property taxes are due. There's also all set due next year, I think in February and then April, but you can prepay those if you want to get the early deductions. And I think that's what's kind of driving, if you have the cash on hand, reserve,
Yep.
cash flow, it's something to certainly consider doing. Then of course, if you want to prepay any insurance premiums, pay them now, and it'll count for deductions here in this year. Obviously, it all depends upon the cash flow position of each client, but we have a lot of clients who are like, go ahead and just pay for it now, so we get the deduction this year versus kind of prorating it throughout the year.
100%. Jed, I want to ask you about repairs.
Sure. Like I said earlier, and we've said, you really want to make sure that you take care of all the expenses associated with those repairs: contractor bills, vendors, materials, supplies, engineering, drawings that you might need for several of the balcony retrofits. Jared, we've had to engage engineering firms to give us new designs and redesigns to satisfy the requirements. And so all of that you want to get done before the end of the year, so you can catalog it and write it off against what your revenues are for this year. Not only to make sure that you minimize your tax burden, but also then to have it in reserve for the future. What do I mean by that? If you're able to zero out your taxes as a result of all your deductions, you actually get to carry those over to the next year. So it becomes something that you can amortize and take year over year. You can't take the full amount the following years, but you can take a portion of it. So you build up a reserve of deductions that you can draw from if one year you find that you've spent a considerable amount and have been able to have a pretty significant deduction, so much so that you've zeroed out your tax burden for the year. You can still carry it forward moving forward. Again, talk to your CPA and the specifics of your financial situation, but those are options.
For sure. And nothing says the holiday season, gentlemen, like reviewing your expense logs, credit cards, and bank accounts. I just hear, the sounds of bells right now when I'm thinking about this. So break out your eggnog, folks, or your dreidels, and let's talk about what does it mean when we're sitting here reviewing expense logs. Jed, maybe you want to just tackle that real quickly, because Jared, I want to ask you about something else in a second. But Jed, if you
Sure.
could jump on that one.
Absolutely. Listen, we know all of our owners are very busy, and January was a long, long time ago in a galaxy far, far away. And so there are expenses that you might have missed from January, first quarter, second quarter. It's very easy to do. That overlooked Home Depot bill for the supply run you went to fix a door or something else, right? And so that is why we strongly encourage you to go back and pay particular attention to your credit cards and expense logs from the first and second quarter, maybe even the third quarter, sometime this summer, right? Because again, those times are, a little bit hard to recall, and you may have overlooked something, and you don't want to forego a few $1,000s of deductible expense or your mileage log that you need to go back and fill in for what you didn't do, so that you have an accurate record and can reflect all those mileage dollars that you can collect and take as deduction. So do yourself a favor, take 15 minutes out, go look at your credit card statements, go look at your bank statements, go look at your expense logs and your travel mileage logs. 15 minutes could save you $15,000. Okay. So that's a pretty good ROI on that 15 minutes.
Got it. Oh, what a way to spend a winter vacation with your family, right?
And I think the best practice would you track your expenses as they go. I
for
think
sure.
Really a challenge to Jit's point to be here at the end of the year. January, Q1, Q2 was so long ago, and to go back and you're just going to increase the likelihood of missing those deductions. So the best practice would be to either hire a professional management company that tracks those for you, or if you're doing it yourself and mom and pop, fine, but do it kind of as you go. Otherwise, you are going to miss the opportunities on those deductions.
Got it. Jared, I know charity, giving back to the community, I know is important to both of you guys, but Jared, I wanted to ask you about this, about making charitable donations. Can you talk to folks about that?
Yeah, I mean, the slide is kind of self-evident, but yeah, I always believe in taking minimum 10% of your revenue or your income for the year and donating that to charity, and any charity of your choice. I always say, if you're at 10% and it's easy to do, great. Then push it up a little bit higher. Get uncomfortable with your charitable donations, and if you feel like, okay, you're at your highest
That
peak,
capacity.
that capacity, do a little bit more, and that'll go a long way. I think it's the right thing to do from a moral standpoint, ethical standpoint, but also has some terrific tax benefits as well.
Got it. Love it. All right. So as folks are doing all this stuff, let's talk strategic tax planning. I got a few things here that I want us to talk about, and I put them all on the screen because I think a lot of them sort of interplay with each other. But if one of you wants to go tackle some of these, let me know. Jump in on it.
Sure. Let me jump in on a couple of them. Leverage your depreciation schedules and cost segregation. This is again what we were talking about, but looking at it from a very specific lens of you want to make sure that you isolate your business expenses, as Jared calls it, for all of your properties, because your properties are businesses, little or otherwise, and you separate those from what might be personal expenses, so that you don't run into trouble with the IRS or anybody else for inadvertently taking a deduction on a meal that really wasn't a meal that you should really have taken, right? And you really want to make sure that you separate those two, and take advantage of those accelerated depreciation and the bonus depreciation and the capital improvement depreciations, which are often overlooked because people don't realize that they're eligible for those. As Jared had said, you have a tenant who vacated, you've got to completely redo the unit. That's a capital improvement to do it from soup to nuts. Might cost you 10, 12, 15, 20 grand, depending on how badly they left it and all that it needs to happen or more. And all of that becomes a capital improvement and now is a separate depreciation. The other thing to really think about is using 1031 exchanges or DSTs. DSTs are Delaware Statutory Trusts, to defer capital gains. And essentially what you're doing here is you're taking advantage of an IRS opportunity to defer your taxes from a gain on an individual and an investment property in a like for like exchange. So the 1031, for example, if you have $1 million 5 to 25 unit building, which is our sweet spot, then you're able to take the proceeds of that profits that you might get from that $1 million building and roll it over into, say, a $2 or a $3 million building using that $1 million without any taxes incurred on it. That's what a 1031 exchange is. A DST is like a 1031 exchange, but instead of a like for like, you're exchanging a like for multiple. So you're not buying one building and replacing with another, or selling one building and replacing with another. Instead, you're selling one building and buying into a portfolio of more than one building. So a lot of high net worth individuals, a lot of our clients will do a DST exchange instead of a 1031. That way they don't have to do a building for building exchange. They can do a building for multiple building, or a building for platform exchange, which actually allows them to be involved in multiple buildings through the DST and not have to just have one building like you would in a typical 1031 exchange. And again, these are all tactics to make sure that you're separating your ability to take your proceeds from that investment and invest it without having to get any taxes, and keeping your business and private separate. And as we like to say, a penny deferred is a penny earning, right? It's that same penny saved is a penny earned. This is another way of thinking about it, right? Any penny that you can defer is another penny that's earning for you as an owner, generating wealth, generating capital. I'm not sure if Edison loves that quote, but I think it makes a lot of sense in terms of, hey, this is how you can really get some good bang for your buck.
Got it. Love it. So, Jared, want to ask you, what are ways that K.I.G helps owners? You've been doing this a long time. Obviously, you're CEO of the company. What are some of the ways that you're helping folks?
Yeah. So I mean, let's also, I think, mention this. We are not tax advisor, professional tax advisors. So, but we know enough to certainly help direct our clients in the appropriate manner. We talked about this previously. Year-end expense tracking reports, right? So one of the things that we do is we have all we just really by a spit of a button can generate for us a year to date or full year expense report that shows all of the money, all the money coming in, revenue, but all the money going out as well. And that report will then just be handed over to the CPA and our clients, and it's a lot easier than tracking it kind of penny by penny on a Excel spreadsheet. We also provide to the clients the underlying backup invoice to support that charge as well, so they can actually see the not only the line item of what was charged and which vendor was paid to, but the actual underlying invoice of the vendor. The other thing we can do is really maintenance coordination, right? So if you know that, for example, the balcony, I go back to the balcony, those inspections have to be done by the end of this year. And so if you haven't done it yet, you're behind the 8 ball. You've got to get that done. So K.I.G Property Management can help our clients with the coordination of any sort of maintenance or repair or capital improvements or inspections that need to be done so that we can capitalize those deductions for this year. The other thing we can do is over the years, we just have built tremendous relationships, not only with insurance agents and other brokers, et cetera, and other vendors, but also CPAs and professional accounting folks as well, and those who actually specialize in real estate. So those are obviously referrals that we're happy to pass on and make. And obviously the choice is up to our clients whether or not they engage them. K.I.G has no interest whatsoever in those relationships other than to make sure our clients are getting great quality service at reasonable prices. And that's fair for all. So that's all we really care about, is the job gets done well.
Yeah, love it. Wanted to quickly check. I know we're getting close on time here, but just a few case examples. I know we once had an owner manage 3 units. They missed $7,500 in eligible tax deductions. I remember they came to us, and it was a couple of years ago, and realized all this. And then we were able to really help track these things. Like you said, we are not professionals, but we cooperated with their CPA. And for the following year, we were able to help their deductions. And I think we've calculated out recently, Joe, that we saved them something like $2,200.
Yes.
Yeah. Amazing when we can do that kind of stuff for our clients. And Jit, I remember you and I worked with this client in particular. We had an owner who had a quadplex who missed some of those improvement deductions. And then we did the electrical wiring. We did those capital improvements that we talked about at the beginning, those bigger capital improvements. And we were able to help reduce them, get those deductions up by 34%. And incredible. I mean, a result of $3,100 in after-tax cash flow. I mean, that's significant money, especially when a lot of owners these days are feeling really pinched by all the regulations that folks are going through. There's just more and more expenses. So this, I think of like, maybe we need to rebrand like tax and say, this is a positive, like call your CPA, find money. There is money to be found, folks. If this is going to be, I was being facetious earlier, like what an exciting way to spend your winter break with your family, but maybe it is a really great way because it's going to help fund your life.
And Derek, to your point, this isn't just low-hanging fruit. This is fruit that's on the ground, fell off and rotting, waiting for you to just bend over and pick it up. I mean, that's how easy some of this might be.
Love it. This is truly, truly wonderful when we can help this. And then I remember we had an owner who managed an 8-unit multifamily unit, apartment buildings, and they missed, again, improvement deductions. Totally missed it. We came in, we brought our balcony team our vendor that we work with, who's fantastic, a wonderful balcony guy. And we help increase their deductions by 47%. And that gave them $5,600 back in their pocket.
Yeah.
So this is finding money, folks. Like just that's right there. So, this end of year, we're all about lists, whether it's Santa's list or your own list for gifts that you've got to get for a million people. Let's talk year-end checklists. I think everybody likes checklists. So if anyone's watching this or the people that are watching this, maybe screenshot this one because I think this is critical. Jared, you want to run through this checklist real quickly? I think you
Yeah,
touched on so
yeah.
many.
Firstly, you want to gather all your expense receipts. You want to schedule final repairs and maintenance. Either you're utilizing a third-party professional management company or your own stuff, that's fine. But schedule those finals inspections, final repairs, final maintenance, capital improvements, etc. You also want to verify your property taxes and insurance payments. Get those if you can, based upon cash flow. Get those done now this year. You want to also have a conversation with your CPA to update them on any assets that you may have acquired or sold in the year. And you want to confirm the corresponding depreciation values associated with each of those assets. And then, of course, if you'd like to, we would be happy to work with you. Contact K.I.G to review your 2025 property performance, making sure that you're performing in a strong and viable means so that to set you up with strength for 2026 in the following year.
I love it. I love it. Yeah, really handy checklist. Thank you, gentlemen. All right, we got a minute or two here for some questions. We have folks that are chatting questions to me. Question is, uh, do you have to keep the receipts of the work that's done? And if so, for how long? Jared, you want to grab that one?
Yeah, absolutely. You want to keep the receipts, and I think the rule of thumb is 7 years to keep those receipts. And don't worry if you are a KIG a client, we keep those for you. But if you don't have us and you're doing this on your own, definitely want to hold on to those receipts for 7 years.
Got it. Next question is, let me read this. Can you walk through an example of how K.I.G increased a client's after-tax cash flow? Well, we did talk about that, some of
Right.
the case examples. So yeah, thank you, listener. We appreciate you probably put that in before you saw the deck. So love that. What should I be doing before December 1st if I want to reduce my tax burden? Well, Jit, I think we just gave a phenomenal checklist. And Jit, you've been, I mean, as we've all been owning and managing properties, but you've been doing it for quite a while in different parts of California. Did we miss anything on that checklist or anything that you would want to add to reduce? I mean, was that a pretty substantive check?
Yeah. I think it was a pretty solid checklist. I would say that the thing to keep in mind is the deductions that we were talking about, some of those bonus deductions and some of those opportunities for accelerated deductions for the capital improvements and whatnot, because owners often forget or don't even realize that they can do that. Absolutely.
Got it. Fantastic. And the last question is, how does K.I.G coordinate end of year repairs or upgrades so we can lock in write-offs? Jared, talk to us. Like, obviously, K.I.G has their preferred vendors, but will you also work with outside vendors and so on, like balcony inspections? So I think you talked about that, but maybe this viewer wants to flesh that out a little bit more.
Yeah, so if I understand that there's two parts to that question, but certainly yes, we can work with any vendor, right? As long as we look for three things when we hire a vendor: the price, quality of work, and timeliness. The price has to be fair and reasonable. We're not going to overpay, but I also don't want dirt cheap because that usually means we're sacrificing on the second, which is quality of work, right? Quality of service. And then the timeliness has to be such that we can get the work done by the end of the year, by December 31st, or at least certainly start the work and make some progress. So yes, we can coordinate with our own vendors that we have a preferred vendors relationship with, that we know have a history with, that they can provide fair pricing, quality of work, and timeliness. But if a client says, I really love my own HVAC guy, I want to use my own HVAC guy, totally fine. We will help coordinate that and oversee any sort of repair or work that needs to be done with that particular vendor.
Yeah, and I know you've always said, like, whenever we have to work with outside vendors, like, we never charge an inconvenience tax on top of that.
No,
A lot of
no.
property management companies, if you don't use their preferred vendors and you make them go through Yelp and call other people, like, they charge you for that time, 20-30% on top of the job. As we say, we're here to make money with you. We're not here to make money off of you. So I'm not
Correct.
here to nickel and dime. Oh, you had to go to this vendor for an end of the year upgrade. Okay, let me add in a couple extra bucks because you inconvenienced me to make a phone call. So
Yeah, I think that's unethical, and it
yeah,
really we like to be aligned with our clients,
Yep.
and yeah, there's a lot of management companies that will pad the invoices, and I think it's unethical, and it's not who we are.
Absolutely. Jared Carpel, Jit Agarwal, gentlemen, thank you so much. This was really exciting, very interesting stuff. Thank you
As
for
exciting
your time.
as tax can be.
I mean, if there's any exciting topic, it's finding money. And I think
Correct.
that's what I gathered from this conversation. I went full like I was ready to fall asleep, but wait, we are finding people money, folks. You have money to be found. Go find it. And in that process of doing that, if you need help with property management, please feel free to give us a call, shoot us an email, whatever it may be. We've been doing this a long time. Both Jared and I are former real estate lawyers, so we've definitely put our legal hats on when we manage real estate like this. We don't have an accounting background, but we can certainly help you with these kinds of stuff. And Jit has certainly helped his own properties and our businesses and many other businesses across the world to scale and to be able to run smoothly and efficiently and effectively. And that's the kind of elevated property management service that we are providing over here. So if you think we're a good fit for you, reach out to us. We look forward to seeing you. Until then, wish everyone a very happy holidays and a very happy new year. And we look forward to seeing you all in 2026. Thanks so much.
Thank you, everybody.
Thanks, Derek. Appreciate you. Thanks, Jit.